I'll get into it. Supermicro Computer, symbol SMCI on the NASDAQ, is a provider of application-optimized high-performance server and storage solution. The company develops and builds server solutions at scale with its building block solutions. Really, it's a server rack provider. They put together various components from other manufacturers, and then they put them together into certain configurations, and they ship it out to really large databases. So we previously covered the stock in March, and at the time it was trading at $1,085 a share, and it went a bit higher after that, but it was right around the peak when we covered it. And at that time, it was up 283% year to date and up 965% over 1 year. It was really that AI surge success story, which was getting played on the market at the time. It was on all sorts of retail investor boards. It was just, the hype around it was just astronomical at the time. Now, over the past 6 months, we've really seen the opposite. The stock is now down 58% over the past 6 months, trading at $4.52 a share. And I think since I wrote this, even went a bit lower by the time of closes. Like I mentioned earlier in the store, they were in the podcast, the stock market hasn't done great today, and it is now at 26.5 billion market cap. So what has changed? When I was looking at this previously, I did mention the stock was extremely expensive at that peak price during the year. It was at a PE of 85 times, a gap PE, trailing PE of 85 times, compared to a historic average about 19.5 times, and a forward price to sales at the time, because they do release guidance for their sales for the year, of 4.2 times, and that is significantly higher than the historic, which is around 0.6, 0.5 times. So very high, about 8 times of what they would be historically priced at for a price to sales. The gap PE has now, however, fallen to about 22 times, so just above that historic value, but price to sales is still elevated at 1.8 times. That is still well above that historic value, which we saw in the past 5 years or so. And this was really the core gripe I had with SMCI at the time. It was just price to perfection or over perfection for not just the coming fiscal year, but that would require growth at well above the previous historic levels for years to come. So when you're looking at these, what we would call, and others would call price perfection stock, you're not normally looking at just the near-term results of they need to be good or great. They need to be having great, excellent results for the next 2, 3, 5 years, sometimes even 10 years to come. And those are the really, when you're coming from a value investor perspective, that you don't really want to touch. And that's the issue we had. And the company was really riding that AI wave. They still are pushing it themselves, that AI narrative. And as we've seen over the past 6 months or so, that general market consensus of that this AI boom has really tapered off a bit. It's still, I would say, there, but I wouldn't say it's as strong as what we were seeing earlier in the year or late last year. It's not every single headline, every single transcript has AI mentioned 50, 100 times. And it's not that same hype as around which we were seeing. And I think that's really fallen off in that retail investor base, which was really enjoying this stock earlier in the year. As well, since then, we've had 2 quarters and fiscal Q3 and unaudited Q4 statement, which is a important point I want to get into in a minute. For both quarters, sales were within guidance, and for fiscal Q3, non-GAAP EPS was above guidance, and fiscal Q4 non-GAAP EPS, however, was well below what they were guiding at the time. After both quarters, we saw a decline and a short-term negative reaction to the stock price. Something we bring up relatively consistently is sales growth really just doesn't matter until it hits that bottom line, then starts to convert to cash. And you can see that conversion going from sales to bottom line, and as well at the same time to cash, or a very easy way to see it convert to cash. As at the end of the day, that's really what drives both business growth, and ultimately what dictates the value of a stock is that cash flow, is that earnings. And speaking of cash flow, it was negative for both Q4 and the year at a deficit of 0.6 billion and 2.5 billion respectively, causing the company to now fall into actually a net debt position of $500 million, where previously was a net cash position, which is a bit more appealing, as it does de-risk a company when you are in a net cash position, as you don't need to raise capital, you don't need to raise debt. And now they're in a net debt position, negative cash flow. It's a little more risky just on the balance sheet side alone. As well, perhaps what was making the headlines a bit more, even though it's only been a fraction of the drop. Last week, the company had a short seller report issued by Hindenburg Research they covered things like the Danny Group. They had another big one which I'll put on the screen. The name escapes me right now. The point of the report that they issued, which they allege, I'm not going to say that they're fact at this time, is many short sellers, they really play up the facts. Even if they are a fact, they really want to make it underline it and point to a million different things. So the main 5 points they had: channel stuffing and early recognition of revenue, which inflates sales figure. This is fraud. Rehiring of previous senior staff who were removed due to SEC charges in 2015, and then they were charged in 2018 for premature recognition of revenue. So same thing as what they're alleging that SMCI is doing at this time, as well as related party transactions worth $1 billion between family members of the CEO, as well as undisclosed related party transactions. Further, product issues such as incomplete products being received, bad reliability, as well as increased competition from the likes of Dell and HP, as well evading sanctions against Russia through various shell companies. It is uncommon, like I was saying, for short reports to have a myriad of reasons with varying validity and importance, and this report is no exception. However, the company has now delayed its 10K or its audited result, which really, to me and most of the market, means that there's some validity to the short report. To what degree and what point, it's the question at this time, as obviously when you're discussing things like fraud, you're going to have pushback from the company, whether it's true or not immediately. That's going to be the first news post, is they're dismissing the report. But whether it's true or not, it will come out 6 months, a year from now when this 10K is filed, which occasionally you do when you see fraud cases. If the fraud is true, the 10K might not be reported for another 3 months. And that can just have a gloomy nature around the company for the next 3 months, year, depending on how long it takes. And depending on the company, you can really just leave that aura of negativity, even if it does not come out to be true. However, the stock fell 19% after this after the short report was issued and the 10K was announced to be delayed, leaving it in this current $450 or so price range. As well, a quick aside, when you see these fraud cases involving accounting manipulation on the sales side, cash flows normally aren't impacted to the same degree, as cash is hard to manipulate, as it's effectively in the bank, or it isn't. So if the auditor is doing their job, they can see the cash is in this bank account or not. Where sales recognition, it gets more complicated and it's harder for auditors to catch even. So it's more commonly that's manipulated over the cash. So if you are saying, oh, I don't want to look at fraudulent companies, you become a value investor as you're looking at cash flows ultimately. And that's really where you see these fraudulent cases, is these massive high growth companies. They're selling you the story, and is ultimately just fiction, as it's easier to fake sales. So just to summarize, the stock, in my opinion, was very overvalued 6 months ago, and the following quarters were just not that same explosive growth that the market was really expecting, even if it was within guidance, which is what we mean when the stock is really priced to perfection. You can't just have average results. You need great, excellent results quarter after quarter, year after year, until that valuation is actually more reasonable again. Further, the AI theme boom seems to have really waned, driving less money into the theme. And last but not least, the accusations of fraud and just the other 50 things they highlight. I only highlighted the headlines there. It's a very long written short report, which ultimately it results in the delay of the 10K, so it at least has some sort of validity. Overall, not just the share price, but potentially the entire business was built really on a house of cards, which now appears to be at least wobbling a bit, if not collapsing, making Super Microcomputer our dog of the week.
Yeah, sorry, Aaron, I think you're muted.
I was looking at the analyst expectations on Supermicro, and so after doubling earnings last year, it looks like analysts are still expecting 50% earnings growth this year and then another 40% earnings growth next year. So this is non-GAAP. But then, that's about 1.3 billion in non-GAAP earnings reported for last year. But as you noted, negative cash flow, negative 2.5 billion in cash flow. So, I mean, that would be a major concern. It looks like it's a company that has really good growth, but the fact that they weren't able to translate that into positive cash flow is something that you'd need to look further into for anybody who's considering an investment.
Exactly. And really the other factor which I would say at play, and I will just before I get into that, that's based off an audited results that at this point could change.
Yes.
So yeah, that is
Yeah.
something you should be aware of. Even me saying 2.5 billion negative deficit, that could end up changing as well.
Mm-hmm.
And as well as the sales figure, which they have reported, it could end up changed after they're audited. But the other factor, which I would really say, is that margin decline. It's server racks. It's a relatively commoditized business. It's not like a exact commodity. It's not an oil or gold or something, but it's a very low differentiation. They're really putting these components together. They're not the one who's really innovating. They're doing a bit, but it's not like this drastic difference. That's why you have Dell and HP. SMCI was really the first mover, and now you're starting to see this first mover advantage start to disappear, really, and that they had really inflated margins over when you were looking at it earlier in this year. And if that does start to come down, that's why you have such a high sales multiple right now. And if that does
Yeah.
start to come down to historic levels, you're looking at a quarter of the value it is right now if the margins do start to collapse during the next year or two.
Yeah, you said price to sales was 0.6 in that range, and it was
Historically.
it. Yeah, yeah, and like that again for the business that they're in. When this is not a SaaS technology company that has a massive moat around it or anything. I mean, they look like you said. It looks like a first mover who took advantage of that, and good on them for doing that. But do you deserve 80 times, 70 times, 60 times earnings? And it is interesting to see now the PE start to trend back to the price to cash flow, trend back to like their 5-year, 10-year average. But the price to sales is still elevated. And if you see a margin situation that continues to correct, that's where you can really get in trouble when you're holding a company like that. And you had a great run, but if there's nothing to protect their margins, that's an issue.